Sometimes we look at a portfolio and we find something very glaring. Anything that's red, like this one right here, Palantir Jan 20 $35 call. Right now the play is in the red for about maybe 5%. I bought them at like $11 and right now is at $10.40, so 5% down. But we need to realize what kind of play it is. This is a long call. This is a home run play. So in fact, I wouldn't mind if Palantir crashes temporarily, and these option contracts absolutely get slaughtered by more than half. I wouldn't mind that. Let me explain. Welcome back, mindful investors. In this video, I'm going to talk about the long call and my 3 bullet strategies and the mindset behind it, how it works, and why I choose to implement it sometimes but not all the time. Let's go. Sometimes when I talk to my friends about the stock market, they always say that it's risky and you can lose money. Well, that's definitely true that you may lose money, but looking at the brighter side of things, you can also win. And over the course of a 10-year time frame, we always start off lower than we end, which means that the market ultimately triggers upwards like this. But anywhere in the middle is where volatility comes in, and we expect a roller coaster ride. But in the options game, it's even worse. These fluctuations multiplies itself. So instead of getting these 5% fluctuations, we get 30% to 50%. And that is normal. After knowing these concepts, we'll go back to the first point I made in the beginning of the video. Why don't I mind some of these positions going in the red? And that's the theory of losing the battle but winning the war. Anywhere in the middle, I could be losing. But I'd be more than happy if the very end is how I envisioned it. Much higher than the beginning. So ultimately, these fluctuations are opportunities to buy, especially at the dips. Okay, before we get to the 3 bullet strategies, we need to meet a couple conditions. So number 1 would be the time frame. We keep talking about these 2 points. For the stock market, it's a 10-year or even longer time frame. But for the options market, it's much narrower. The max you can go are maybe like a 3-year leap. So the time frame matters. Let's say if you're buying long calls for a couple weeks or a month, so you need the exact action to happen within this month. Either a straight up rocket like this or a complete bust like that. So you need all that to happen within this month. You won't have much room to play with. If you're betting for the long call that things will go straight up like this, if it turns the other way and drops 10%, because if the stock price drops 10-15%, the option's already down 50+%. Which means that the stock has to make up this 15% and jump up another 10-15% in order for you to be profitable. And this time frame is shrinking on you, like day by day, week by week, it's just eating into your premiums. That's why we need a longer time frame, so we can really stomach these drops and ride it out until profitability. As I always say, anything can happen in the very short term. But in the long term, things may play out the way you envision it, hopefully into profitability. And then number 2 is the conviction that I always talk about. Like how much conviction you have that this stock right here will be much higher at a later date. And are you willing to ride it out even if it drops 50% and it stays that way for a couple months? Is that okay? Do you truly believe in the company, or are you just riding the hype? And that's okay too. If you know that you're just riding the hype up, you just set stop losses along the way. Maybe if it goes down 25%, you just cut it all and move on to the next one. But here for the 3 bullet play, we need the ultimate conviction that you believe this stock would double over the next 2 years. We're talking about 2-year, 3-year time frames, not 2 months, 3 months. Because 2 months, 3 months, absolutely no one can predict. Absolutely nobody. Okay, number 3 is a plan. As I mentioned a couple of times, is a 3 bullet strategy. So what is this exactly? It's very simple. So imagine you just have 3 bullets to fire. How and when do you fire these bullets? Well, the first bullet is not that critical. You just take the first shot when you find a good opportunity. Let's say if the stock dropped like 5-10% and you feel that is a local bottom. So therefore, when you buy it, you are at a discount. Number 1, buy on swings. And buying on swings will get you that extra edge. But ultimately, if you're right about the big play, the macro play, the end game play, then these 5-10% doesn't even matter. And when you shoot the second bullet is when your number 1 play has gone down 50%. So minus 50%. That's your second one. As I mentioned before, the name of the game is volatility. In the options market, this effect multiplies, maybe to the 5x. So if the stock drops 10%, then your options are down 50%, possibly. So there is your second bullet. And your third bullet is when your second bullet goes down 50%. So ultimately, when you bought the first bullet is at $1. The second bullet is at 50 cents. The third bullet is at 25 cents. So there is your 3 bullets. And these 3 bullets are equal in size, 1/3 each. Now let's talk about the reasoning behind this and why it works. Okay, as I mentioned before, when a stock that's like $100, it drops 50% to $50, you need this to go up 100% in order for you to get back to even or into profitability. But if you shot your second bullet when it dropped down 50%, then let's say your first step, we have 1 share at $100. And number 2, we bought 2 shares at $50. So together, we have 3 shares and we paid a total of $200. Therefore, your average price is 200 divided by 3 equals 66.7. And then with the stock price at $50 right now to $66, this is only a 33% gain that you need in order for you to break even. And this theory plays out for the third one as well. When it drops to $25 and you buy more shares, and therefore your average price is much lower and the amount the stock needs to go up needs to be less because you gain more shares and your average price is much lower now. Ultimately, it comes down to conviction. If the stock continues to drop or just flatlines, it never picks up like how you envisioned it, then you lose your 3 ammos. That's why we have number 4 is Betsizing. So with these 3 bullets together, you need to have that ride or die mentality. So you're actually okay to lose all 3 bullets. Because the reward at the end, if everything pays off and it actually tanks, your option contracts absolutely gets demolished when you can actually buy the third bullet at 75% off. We actually found the ultimate bottom and things shoot up the other way. All this will pay off huge. Like these 3 bullets will turn to 30 bullets. Like that's the ultimate multiplier. Bet sizing is absolutely key because if your bet sizing is too huge, you probably cut it off at the 2 bullet range maybe. And that's due to the fact that we bet too big and your conviction isn't as strong. In order to be successful with this home run play and the 3 bullet strategy, we need to control these 3 factors and just hope that everything turns out the way you envisioned it. That your end game is much higher than your initial play. I know it's a lot to take in. Let me know if you got any questions. It's just a play I kind of made up. Hit the like and subscribe buttons if you found any value in the video. Thanks again for watching. Take care and I'll see you in the next one.